Last week, U.S. natural gas futures fell as the May contract approached expiration. The decline was largely driven by reduced feed gas to Freeport LNG's Texas export terminal and a considerable surplus in gas storage. The latest report from the EIA revealed that utilities injected 92 billion cubic feet of gas into storage, and current storage levels now stand at 2,425 billion cubic feet, which is significantly higher than the 5-year average by 655 billion cubic feet. Operational disruptions at Freeport LNG have compounded the downward pressure on U.S. gas prices, simultaneously impacting European markets. Market analysts attribute the declining prices primarily to the repeated outages at Freeport, coupled with current weather conditions. However, the resumption of operations signaled by the departure of the first tanker since the recent outage offers a glimmer of hope for stabilization. Analysts forecast a drop in gas demand across the U.S. from 99 billion cubic feet per day last week to 92 next week. At the same time, production has decreased from 100.8 billion cubic feet per day in March to 99.6 in April, further evidencing a market surplus. In the short term, the U.S. nat gas outlook stays bearish due to persistent surpluses in storage and production. Although the restart of operations at Freeport LNG could offer some relief, prevailing market dynamics, characterized by ample supply and tempered demand, are expected to keep prices subdued in the upcoming week. However, looking further ahead, nat gas might be poised for a sustained uptrend, fueled by increasing demand from mainland Europe and the UK as they begin restocking ahead of this year's fall and winter. Consequently, steady demand is anticipated throughout the spring and summer seasons. Meanwhile, supply challenges in Norway and the US, stemming from unexpected maintenance and outages in select LNG facilities, may exacerbate any disruptions, potentially propelling gas prices to $2.50 during the summer. Furthermore, if August sees hotter than average weather along with initial forecasts for a cold winter, gas prices may spike above the $3 threshold in late summer. Eventually, there will be an upward spike, either triggered by a mid-summer heatwave or by anticipation of colder temperatures later in the year. In history, natural gas dipped below the $2 mark only twice. The first instance was in 2016, lasting for only 2 months, while the most significant occurrence was in 2020, with prices remaining below $2 for 6 consecutive months. Assuming this 6-month duration represents the longest possible period for low prices, it would align perfectly with the anticipated hot August and the commencement of gas accumulation ahead of the winter season. I wouldn't be surprised to see gas prices skyrocket to over $4 later this year. Gas prices are expected to remain stable around their current lows for the next 1 or 2 weeks, after which a change in sentiment is anticipated. Weekly technical analysis shows the 8-week moving average acting as consistent support for the past 3 weeks, forming an upward trend trajectory. The next level to monitor is $2.15. On the other side, the $1.93 handle has worked as nearby support for now. If the 8-week moving average manages to defend the $1.93 support, this will continue the upward trend reversal in the coming weeks. Thank you for watching. Please like and comment to support the channel. See you in the next one.